There was plenty for investors in Japan to navigate on Wednesday, with major developments spanning trade, central bank policy, along with political uncertainty. It began early in the session with the announcement of a major US-Japanese trade deal, including the US cutting auto tariffs from 25 to 15%. That came in exchange for $550 billion worth of Japanese investment into the United States, including new lending. The news sent Japanese equities surging, with the Nikkei up over 3%, hitting year-to-date highs. Auto stocks like Toyota and Honda posted double-digit gains, staging a relief rally as tariff rates were slated to be 55%, starting from August 1. Front-end JGB yields rose as swaps priced in an 80% chance of a BOJ rate hike by year-end. That came despite dovish commentary from BOJ Deputy Governor Uchida during the session, who highlighted downside risks to growth from global trade tensions. However, he also noted that inflation was proving to be stickier than expected, especially in food categories. Later in the session, reports then surfaced that Japanese Prime Minister Ishiba plans to resign next month following a poor election result over the weekend. That pressured the yen and pushed up longer-dated JGB yields. Political instability may lead to more expansive fiscal policy and larger Japanese deficits, especially with opposition parties pushing for more aggressive spending. That concern was reflected in a soft 40-year JGB auction, which drew the weakest demand in 14 years. Despite the result, the Japanese curve bear flattened, with a sell-off concentrated at the front end and belly as markets remain focused on the BOJ tightening prospects. For now, risk appetite remains buoyant, underpinned by the trade breakthrough, and hopes for a similar outcome can be reached between the EU and US. However, for the risk rebound to be sustained, the bond market must remain on board.